Thank you for joining us for our webinar today, Keep the Horse in the Barn, How Internal Controls Protect Your Organization from Fraud. In this brief 30-minute session, we will expose you to some important information about fraud and how internal controls can help protect your organization. But before we get started, I wanted to mention that there's a chat feature for this webinar, and you can ask your questions at any time during the presentation. The chat button is at the bottom of the PowerPoint as you hover over it. We will answer all the questions at the end of the webinar during the question and answer portion, but feel free to ask questions via chat as you think of them. And now I will turn it over to Douglas.
Well, good afternoon. My name is Douglas Berry, and I'm the Principal in charge of Assurance Services here at SVA. Joining me today is my colleague Mandy Paskey, who is a part of our risk management team. Now, both Mandy and I work with organizations to help them strengthen internal controls, that is, to build better fences and barn doors, but as a certified fraud examiner, Mandy is often called in to help when the horse gets out. Now, full disclosure before we get going, neither Mandy nor I are horse people. We just hope that some of these funny analogies will help illustrate the concepts that we present today. So for purposes of today's webinar, the horse represents something that's important to you or your organization, whether that's some type of physical assets, maybe it's trade secrets, competitive advantage, your business reputation, anything like that. The fencing and doors are controls that your organization implements to protect that horse. So we've got 5 items on the agenda today. We're going to talk quickly about why fencing and doors are important, walk the fence line, what good fencing and solid barn doors look like, what happens if my fencing and doors need repairs, and then we'd like to leave you with some takeaways so that you have a happy and safe horse.
Okay, so why is fencing and doors important? Basically with this is these help protect your organization from occupational fraud, which is generally defined by types of fraud such as stealing, lying, and cheating. Asset misappropriation is described as what we describe as stealing, and it's defined as the theft of company assets such as cash or inventory, and the misuse of company assets, so such as a company car for a personal trip, that type of item. As reported by the Report to the Nations of 2018, which is published by the Association of Certified Fraud Examiners, I will identify that as ACFE during the presentation. The impact of stealing has totaled approximately 89% of cases that were reported, and the median loss on that was $114,000. This is what we describe as being high frequency but a lower impact. The types of schemes that kind of fall under this asset misappropriation is cash schemes such as skimming, cash larceny, and fraudulent disbursements, accounts receivable schemes such as lapping, fictitious receivables, and improper postings of credits, and then inventory such as misappropriating inventory for personal use, stealing inventory and scrap, or charging embezzlements to inventory. This would also include fixed assets, such as employee theft or unauthorized personal use of those fixed assets. Now, financial statement fraud we describe as lying, and this is defined as the deliberate misrepresentation of the financial condition of an enterprise, and this is accomplished through intentional misstatement or omissions of amounts or disclosures that should be included in financial statements, and it's used to deceive the financial statement users. Now, as reported by the Report to the Nations, which is published by the ACFE, the impact of a lying scheme totaled approximately 10% of cases, and the reported median loss on that was $800,000. Now, this is what we describe as low frequency but a high impact to an organization. And finally, our last form of occupational fraud is corruption and bribery, and we kind of describe this as cheating. So corruption is the wrongful use of influence to procure benefits of an actor or another person contrary to the duty or the rights of others. Bribery, which involves the offering, giving, receiving, or soliciting anything of value to influence an official act or business decision. So as reported by the Report to the Nations of 2018, the impact of cheating totaled 38% of cases, and the reported median loss on that was $250,000. These types of schemes are described as being very difficult to prove because it generally includes 2 or more people that would be involved in that type of scheme. So the examples of corruption and bribery can include bribery and kickbacks, illegal gratuities, economic extortion, and an undisclosed conflict of interest. Now, when we talk about walking the fence, a couple of things you want to think about in particular is the fraud triangle. And the fraud triangle is a model for explaining the factors that would cause somebody to commit occupational fraud, and this generally consists of 3 different components that lead to this fraudulent behavior. So perceived pressure is considered a perceived non-shareable financial need. So, you know, if somebody's in a they find that they have a lot of bills coming in, that's what we consider pressure. For perceived opportunity, this is employees that perceive they have an opportunity to commit the crime without being caught. So this is where you have really weak internal controls, and it provides the opportunity for the employee to accomplish the task at hand. And rationalization is justifying a theft that has already occurred and viewing them as essentially non-criminal, as justified, or as part of a general irresponsibility for which they're not completely accountable for. So the fraud triangle originated from Donald Cressy's hypothesis that a trusted person becomes a trust violator when they can conceive of themselves as having a financial problem, which is non-shareable, and aware that this problem can be secretly resolved by the violation of the position of financial trust, and are able to apply to their own conduct in that situation by verbalization, which enables them to adjust their conceptions of themselves as a trusted person with their conceptions of themselves as users of those entrusted funds or the property. As we continue to discuss walking the fence, there's a couple of additional pieces that we want to look at. So we're assessing whether any one individual has that perceived pressure opportunity and can rationalize their decision by addressing these additional areas throughout the risk assessment. So the first thing is ongoing fraud training. For example, do employees understand what can constitute fraud? Do employees know where to seek advice when faced with uncertain ethical decisions, and do they believe they can speak freely about it? And then, has the policy of zero tolerance or fraud been communicated to employees through words and action? The next one is whether or not there's effective fraud reporting mechanism in place. So this would include, how can employees communicate their concerns about known or potential wrongdoing, and is there an anonymous reporting channel available to employees, such as like a third-party hotline? The next is to increase employees' perception of detection and are proactive measures taken and publicized to employees. For example, does the organization itself send a message that it actively seeks out fraudulent conduct through fraud assessment questionings by the auditors, or are surprise audits performed in addition to regularly scheduled fraud audits? The next is management climate, so the tone at the top, one of honesty and integrity. For example, are employees surveyed to determine the extent to which they believe management acts with integrity and honesty, and are their performance goals realistic? The next one is fraud risk assessments, and with this, is there a fraud risk assessment that is performed to proactively identify and mitigate a company's vulnerabilities to internal or external fraud? And kind of continuing with the walking the fence line, we're looking at whether or not an organization has an internal audit department. For example, if one exists. Not every organization has an internal audit department. And it's looking at if that internal audit department has adequate resources and authority to operate effectively and with undue resources, and whether or not that authority, if they have the authority to operate effectively and with undue influence from senior management. The next one is whether or not the organization has hiring policy in place. So within this hiring policy, are criminal and civil background checks being completed? Is there a drug screening? We're looking at education verification in addition to reference checks. The next one is whether or not there's an employee support program in place to assist employees that might be struggling with the addiction or a mental and emotional health, or if there's family or financial problems. The next one is whether or not there's an open door policy within the organization that would allow the employees to speak freely about pressures and then providing management the opportunity to alleviate those pressures before they become acute. The next one is anonymous surveys, so whether or not anonymous surveys are being conducted to assess employee morale. You don't know what you don't know, so assessing employee morale through these anonymous surveys can be super helpful. And then finally, strong anti-fraud controls. Are they in place and are they operating effectively? So this would include your proper segregation of duties, the use of authorizations, physical safeguards, job rotations, and then mandatory vacations.
So good information, Mandy, as we're walking the fence line. What are other things we might want to look at as far as what good fencing and solid barn doors look like? Well, in 1992, the Committee of Sponsoring Organizations of the Treadway Commission, is also called COSO, many people might know, a model that they developed which has become the generally accepted framework for internal controls. And it's become really the definitive standard against which organizations evaluate their systems of internal control. And that model has 5 different components that should be considered when you're looking at internal controls, or like I said, good fencing and solid barn doors. The first is the control environment. Mandy, you mentioned the strong tone at the top, really creating a positive work environment. This is the collective effect of various factors on establishing, enhancing, or in some cases weakening the effectiveness of the entity's accounting system or control procedures and their ability to achieve the objectives that they want. You mentioned integrity and ethical values. It also includes things like a commitment to competence, management's philosophies, and even how the organization itself is structured. Next, we have the risk assessment component, which really is not just company-wide, but also at a process level. How is an organization identifying, and measuring its fraud risks? What kind of analysis is done by management? Probably the piece that most people are familiar with is control activities. This is kind of where the rubber meets the road. Things like policies and procedures. You might have a policies and procedures manual. Encompasses things like security, whether it's network security or physical security, business continuity and backups. These are really the actual activities that your organization performs to mitigate the fraud risks that you identified. Fourth, we have information and communication. In this component, we're really looking at what is the quality of the information that's available to management and the effectiveness of the communication that's done within an organization to carry out an entity's control objectives. And the last component, monitoring, really talks about performing separate evaluations, how things are identified and reported within an organization, particularly when a deficiency is identified. Now, given our short time today, I really want to focus mainly on control activities. Now, there's 5 objectives that I've identified here for control activities. The first one that I'll call the golden rule is a proper segregation of duties. Now, the concept behind segregation of duties is you want no one employee to have one of 4 or all 4 of these key responsibilities. That is, authorizing transactions, recording transactions, maintaining custody of assets, and reconciliation. So no one person should be doing all of that. An example where you might have a good segregation of duties, let's say Adam opens the mail at your organization and pulls out all of the checks and immediately endorses them. He's got a stamp and it says for deposit only XYZ organization. And then Jane records the checks in the accounting system using the log that Adam created. Maybe at the end of the month, Rick is reconciling the bank activity, and then Mary is reviewing that bank reconciliation. So you can see you've got multiple people involved in that example, a cash receipts process. The second objective would be proper authorization of transactions. You really want to make sure that transactions are authorized by your people that are acting within the scope of their authority. So you want to design procedures, so that when somebody is really doing their job, they're acting in a control capacity. So for example, if you're looking at hiring a new employee, maybe you use a job requisition system, and if the sales department wants to hire a new salesperson, then the sales manager or the head of your sales department should be signing off on that job requisition. Third, design and use of adequate documents and records. Not only are adequate documents and records really necessary to ensure proper processing and recording of transactions in your systems, but they also leave an audit trail that when we talk about monitoring as a component of COSO, you need that audit trail in order to be able to do proper monitoring. Adequate safeguards over access to and use of records and assets. One of the things I see all the time is, maybe you're a small not-for-profit organization and you're using a entry-level accounting system like QuickBooks, and you've got one username and password on a Post-it note stuck to the monitor. That's not an adequate safeguard. You really want to limit access to properly authorized personnel, and even within the system, make sure that only people who have the need to access certain functions have access to those functions. And lastly, independent checks on performance and proper evaluation of recorded amounts. This is, I'm showing my age a little bit here, the old Ronald Reagan trust but verify. You want to make sure that somebody other than the employee who carries out an activity performs an independent check of that work. So in the example I gave of segregation of duties, it's the bank reconciliation process, but it could be another check, say a physical inventory count. So I want to touch a little bit on what the different types of internal controls are. So when you're putting together a control system within your organization, the first type you should consider are what we call preventative controls. And this is really the barn doors and the fencing, the true, what we're here to talk about today. And these are generally the strongest type of control. They may be at times more costly to implement, particularly in situations where you have some limited staffing. Now, these controls are preventative in nature in that they keep errors and irregularities from happening in the first place. And they range from things like, locking the barn before you leave so the horse doesn't get out. Things like checking for clerical accuracy, backing up your computer data, screening employees, training programs. We touched on segregation of duties. All of those things fall under preventative controls. The second type, I'll keep with my farm references here, is what I call the sheepdog controls. These are things, monitoring type controls that find errors after they have occurred. So this is the opening to the barn with a camera on it. These types of controls serve as really a checks and balances system and also can help you determine how efficient your policies are. Some examples might include a surprise cash count, taking physical inventory, review and approval of accounting work, even enforcement of job descriptions and expectations. Now, these controls also can help protect assets. So if a cashier doesn't know when her cash drawer will be counted, she's more likely to be honest. The third type of internal control is what I call a corrective internal control. And my apologies to the horse. The only example I could think of was the horsewhip. But really, these types of controls are in place to correct errors that were found by your detective internal control. So what the sheepdog found. And really, when an error is made, employees should follow a certain set of procedures that have been put in place to correct the error. So these types of controls include reporting problems to a supervisor, training programs, and even progressive discipline for errors. Now, our presentation today is really mainly focused on controls over financial reporting, but in today's interconnected high-tech world, I didn't want to be remiss if I didn't at least mention the impact of information systems controls. And one of the keys here is that your information systems controls have to be in sync with your organization's control objectives. So an example might be if you have a policy of proper segregation of duties, but within your accounting software or your IT system, users are allowed to circumvent this policy, that can be problematic. There's two main types of information systems controls. General controls, these are kind of the overall controls, things like passwords, virus protection, maybe you've got a lock on your server room door, and even conducting backups. But there are also application controls which cover a specific application. So maybe you're logging in again to your accounting software. Maybe there are things like input controls that only allow you to enter data in certain fields, or output controls that restrict who can run certain types of reports. Some important considerations when you're evaluating your fencing and barn doors: secure access to systems. Everybody should be required to log in with a secure password. Again, don't write it on the sticky note. Don't forget access controls for databases used by your system. All of those accounting softwares have a database underlying that system, and it's important that you don't allow a good hacker to circumvent your system controls and go directly into the database. Make sure terminated employees are denied access, especially in our cloud-based systems, where anybody can access a system from anywhere, anytime. And make sure people only have access to the modules or functionality in the system that they need to perform their assigned roles. Consider software controls. Maybe you've got something like Positive Pay, which in an accounts payable system, you send a file to your bank of the checks that were issued, and the bank will clear the checks against that list. Business continuity and backups. A lot of organizations say, yeah, we do periodic backups, and yeah, we take them off-site. Our IT director takes it home, or the executive director takes it home, or the owner keeps it. But the one area I see people failing in often is they don't periodically test those backups to make sure that they can be restored. Cybersecurity in this day and age: are you educating employees on cybersecurity risks? Is your organization following a cybersecurity risk management program? Maybe the National Institutes of Standards and Technology cybersecurity framework, or HIPAA, HITRUST, or another framework. And lastly, don't forget the basics. So concepts like proper segregation of duties and redundancy are important in systems controls too. You don't want an IT manager who has all your backup copies of your systems. If you want to terminate that employee, they maybe do a scorched earth policy and destroy all your systems, and now you don't have any backups.
So what happens if my fencing and doors needs repairs? Fraud can happen. We previously discussed the occupational fraud and which includes the asset misappropriation, which we described as stealing, financial statement fraud, which we've defined as lying, and bribery and corruption, which we had termed cheating. So under asset misappropriation, for check and payment tampering, for example, 12% of those cases had reported a cost of $150,000. Additionally, in financial statement fraud, which we described as lying, is the net worth or net income, which utilizes the overstatement and understatement of the financial statements through timing differences. And this can include fictitious or understated revenues and conceal or overstate liabilities and expenses. For bribery and corruption, which we had termed cheating, a couple of things with that. With financial difficulties by the perpetrator, they had reported that 23% of those cases that they had reviewed were related to financial difficulties with regards to red flags. In addition to another red flag, living beyond one's means, it approximated about 43% of the cases reported. Now, in this day and age, sometimes it's not necessarily one person living beyond their means. It might be somebody trying to keep up with their way of life that they have right now. As reported by the Report to the Nation, at the low end of the scale, there is approximately 27% of cases that were reported where the fraud went undetected for 6 months or less, and the median loss on that was $30,000. At the high end of the scale, there was approximately 8% of cases reported where fraud went more than 60 months undetected, and the median loss for those types of fraud cases was $715,000. Now, with payroll schemes, they kind of tend to fall in the middle, where generally 30 months of duration went before the payroll scheme had been detected. One thing to note that in 55% of cases reported, the concealment method used as reported by the Report to the Nation was by the creation of fraudulent physical documents. Alternatively, there were only 20% of cases that had reported where the perpetrator had actually created fraudulent journal entries. And when it comes to what happens with my fencing, if my fencing and doors need repairs, we really need to talk about the nonprofit organizations. When we think about nonprofit organizations, we generally visualize an organization with limited staffing, which puts them at a greater risk of having holes in their fences and weak doors. So with this new tax reform that came out, the non-for-profits are now at a greater risk with the increase in pressures, opportunities, and then rationalizations. So with the pressures with the not-for-profits, this can be described as the decrease in donations or contributions, which then ultimately causes a decrease in a positive outlook and then increases the risk to materially misstate its financial statements. With opportunity, there can be a reduction in cash flow from those donations and contributions, which will likely result in a reduction in staffing or wage freezes or limited budgets. But keep in mind with nonprofits, they already have a limited staffing, so with a reduction in a already limited staffing, this will likely result in also a reduction of segregation of duties, and then this will also increase the risk of employee or organizational fraud. And then rationalization can be justified by those already low wages and wage freezes. This will likely result in staff potentially feeling entitled, or an organization may feel that the tax reform has forced this as being the new norm. Some other impacts to consider when you're looking at whether my fencing or doors, whether I have weak fencing or my doors need repairs, are sabotage. So sabotage can be described as someone gaining access and painting your horse yellow. Also, you can look at losing competitive advantage. This is where the faster horse in a horse race, such as your competitor, begins to nose out from others and losing that competitive advantage. You have a reputation risk where the marketplace could change the odds of your horse. Your horse was slightly hurt, but then rumors started that your horse had to have surgery on the leg. You could be subject to sanctions or fines, so your horse is starting to get costly. Someone is lying about your horse, and now you are fined for your lack of oversight. Errors, omissions, and unintentional acts. This is the horse is making a mess of things after someone had gotten into the barn that seemed to be aggravating your horse. System failures. This is where it's time to call the vet. Your horse isn't feeling up to par. And then finally, natural disasters. The horse really was a good horse, but there were too many holes in your fence that just could not keep her safe.
So I want to leave you with a couple of takeaways for keeping your horse happy and safe. The first, walk your fence line. Be sure to take stock of your organization's current state, review your current controls, and identify where there may be opportunities to strengthen them. Consider those 5 elements of COSO and talk to people outside of the organization's accounting department. There's a lot of good information that happens in the sales department, purchasing, things like that. Consider whether you may benefit from an independent perspective by having an outside specialist help you with your evaluation and come in and make some recommendations for you. Make sure you're monitoring your fencing and doors regularly. I'm often asked, how often should you review your fencing and doors? When should we do this? And really it depends, if your controls have more of that detective nature, that security camera or sheepdog, you're going to want to do it a lot more often than if you've got, a solid barn door or a good piece of fencing in place or a good preventative control. But if you think that horse is injured or you can't find the horse in the barn, what do? Stop. You want to make sure you get help immediately, especially if you detect or suspect fraud. You want to get a certified fraud examiner in who can counsel you on the important first steps. There's a lot of things that need to happen so you don't jeopardize the organization, including securing information assets as well as, whether or not you may want to involve, law enforcement. We have a couple of resources that are available to you on the svaccountants.com website that I'd like to point you to. The first is we do have an ebook, The Importance of Internal Controls, that I encourage everybody to download for free. And then we offer biz tips for all of our friends and the business community as well. These biz tips cover not only help with internal controls, but we talk about everything from business planning, new tax and accounting rules, and other information that can help you and your organization be successful. And then lastly, remember, SVA can help. We encourage you to contact us if you'd like us to design an internal control evaluation that's tailored for your organization, if you have questions about your policies and procedures, or if you need help with something that you suspect at your organization.
Well, it looks like that's all the time we have, but if you have questions, our contact information is provided.
Well, it looks like a question just came in here. You mentioned cybersecurity. We're a small organization and not Target or a big retailer. How concerned should we be about cybersecurity? I'll take that one, Mandy. Well, honestly, I think everyone needs to be concerned about cybersecurity because not all cybercrime is conducted by people seeking financial gain. In the cyber world, we call the people that are out to get you attack adversaries, and some of them, include things like rogue or disgruntled employees, maybe a competitor, and I've even seen, hacktivists, I'll use my air quotes, you can't see on the phone, but these people might be trying to make some kind of political or social statement or even just embarrass you or your organization. So that risk management part of internal control, making sure you really understand where the risks are really important here so you can determine, what horse it is you don't want to get injured and apply good controls there. Let's see. Mandy, looks like there's one for you. If my organization has experienced or been affected by fraud, how likely are we to recover what we've lost?
Well, fraud committed by employees can certainly be devastating, and a company suffers financially related to the amount of the loss, legal expenses, that sort. But employee morale may also drop. Additionally, there is a high probability that the company's reputation could also be affected negatively. So the recovery of loss in part comes down to your insurance coverage and making sure you are really understanding your insurance policy and what is covered. But also recovering everything that was taken possesses several challenges, including determining how much was actually taken and whether it would be criminal or civil case. The fraudster likely doesn't have the funds to pay everything back immediately or even the far future. So the money taken is typically already spent, therefore the organization itself likely will not recover everything that was lost, especially when it comes to the reputation. So when it comes to recovering what you've lost, you really want to make sure that you're looking at all the big picture of everything, not just the monetary value, but also the reputation of the organization.
I'm looking at the time, and it looks like we're just a couple minutes past our half hour. If we didn't have an opportunity to get to your question in our brief time today, please feel free to reach out to us directly. Our contact information, again, is up on your screen. On behalf of Mandy and all of our colleagues at SVA, we want to thank you for attending today. We trust we've given you some ideas to bring back to your organization, and those ideas will help you keep your horse safe and happy.